Hi. Let's learn about incorporation, definition, how it works, and advantages. Incorporation is the legal process used to form a corporate entity or company. A corporation is the resulting legal entity that separates the firm's assets and income from its owners and investors. Corporations can be created in nearly all countries in the world and are usually identified as such by the use of terms such as Inc. or Limited in their names. It is the process of legally declaring a corporate entity as separate from its owners. Incorporation is the broad term to describe a business registered with a state to become a separate legal entity. That business entity often is owned by shareholders that may also be overseen by a board of directors. A company does not need to be incorporated to operate a business. Business owners may elect to operate as a sole proprietorship or a partnership instead, which treat company debt and taxes differently than compared to an incorporated entity. Incorporating allows a business owner to sell an ownership stake in part of the business, which is one of the primary advantages of incorporation. Incorporation involves drafting articles of incorporation, which lists the primary purpose of the business and its location, along with the number of shares and class of stock being issued if any. Companies are owned by their shareholders, who are entitled to receive the profits of the company in the form of dividends. The directors of the company are responsible for day-to-day activities and are elected annually. Smaller companies can have a single director, while larger ones often have a board comprised of a dozen or more directors. There are many steps to incorporating a business, each with its own degree of importance. A business should ensure it is adhering to local business licensing and zoning laws before incorporating, and should choose a business structure and a unique name. A registered agent must be selected, and the articles of incorporation and corporate bylaws must be drafted and filed. There are also other operational tasks a business owner should take as it becomes incorporated, such as applying for an employer identification number and creating a bank account. Incorporation creates a protective bubble of limited liability around a company's shareholders and directors, allowing for easy transfer of ownership and may achieve a lower tax rate than on personal income. However, the drawbacks of an incorporated business include operating constraints and an administrative burden. There may also be double taxation and higher costs associated with maintaining incorporated status. Here are 5 key takeaways. 1. Incorporation is the way that a business is formally organized and officially brought into existence. 2. The process of incorporation involves writing up a document known as the Articles of Incorporation and enumerating the firm's shareholders. 3. In a corporation, the assets and cash flows of the business entity are kept separate from those of the owners and investors, which is called limited liability. 4. Though incorporation, a company's tax liability is also treated differently than that of a sole proprietorship or partnership. 5. Incorporating makes it easier for a business to sell shares, raise capital, and divest ownership from a portion of the business. Hope this would help. Thanks for watching.